Hi everybody, welcome back to another video, another episode of JB&D's Market Sniffs. First and foremost, Merry Christmas. Um, Today is the 24th, it's Christmas Eve. Some of you celebrate today, some of you celebrate tomorrow, and some of you don't celebrate at all. And if you don't celebrate Christmas, happy holidays. We have New Year coming up next. Uh, but yeah, let's get into it. We're gonna, as you can tell by the title, today's focus is going to be on my 2026 outlook, which is pretty much a repeat of 2025. Um, I'm gonna dig for my last year's thesis, last year's predictions, um, and pretty much just reiterate what I said then and back it up with data or graphs and whatnot. But let's get into it, okay? Well, let's see if I have it in the pins. Sorry, guys. Okay, let's see. Yeah, should find it here. This was pretty much my thesis, okay? Right here. Right here, say, okay, guys, I'm ready for the hidden bull market. Like I said previously, there's always a bull market somewhere. Originally, I thought this would only be internationally, but after tons of reading, there's opportunity in US value and small mid caps. The port is already allocated for this. Okay, so backtrack a year ago, exactly a year ago, December. Uh, my bullish thesis was just China, long China, short US, pretty much all of it. I was just bearish US entirely and bullish China, specifically Alibaba. But then, well, this was back in March, 3 months later, after doing some more reading, I noticed that there could be some winners despite a US drawdown, while we also have our Chinese bull market. Okay. Um, right here, this is from March, fund manager survey by Bank of America Global Research. So it showed the biggest drop in U.S. equity allocation on record. So I was bullish here at that point on the U.S. for small, mid cap, and value, because we had that March drop, but we still had another drop that we didn't know was coming in April. But at that point, people were already selling, and that's from March and April. I was buying dips on small mid cap companies for long-term investments. Again, nothing that I say is financial advice. Everything is opinion only. Please talk to your financial advisor before you make any financial decisions. Not liable for anything that you do based off of this podcast. Okay, this is just for educational, informational purposes for myself and anybody that wants to learn. But again, it's all opinion. Anyways, uh, it wasn't any of the tech names. Like, okay, one was PayPal. It's still down. One was Vance. It's gone up since then. Another was Estee Lauder. It's gone up since then. Another one was Canada Goose. It's gone up since then. Another one was Albemarle. It's gone up since then. Another one was I literally have it right here. What am I doing? Look, this is from months ago. Okay, Alibaba, Estee Lauder, Canada Goose, Albemarle, Etsy, PayPal, Vans, Intel, Advanced Auto Parts, GXO Logistics, Generac, and then SQQ and Nvidia puts were my hedges. Um, that was then. Now it looks a little bit different. But that was back in March, when I was buying dips into April. Um, but in April, that last drop, the day before the last drop, because I think it was April 7th when I bought the last dips, and then we had one more drop April 8th, something like that. I've mainly focused on these green names right here. I color coded them. The green is for names that have a Chinese connection to them. Blue names just pure US play, and then the red was my short hedges. Green, I focused on those because when we were dropping in April, everything it pretty much had nothing to do with China. It was all about U.S. tariffs. Again, U.S. consumers are the ones that pay for that. U.S. consumers are the ones set to lose, right? This has nothing to do with Alibaba. Alibaba had a tiny, tiny, tiny percentage of their e-commerce sales that go to the U.S. Tiny, tiny percentage. Okay, so um, but my the price never came back down to my cost basis of $84. It dropped down to like 99, 95. So instead of that, of averaging up, I added a bit of Alibaba 2x ETFs, 2x long ETFs. Um, I bought a ton of Estee Lauder in that dip, Canada Goose and Albemarle, because Canada Goose, a third of the sales has to do with China, and they're based in Canada, and another third is just in the US. So again, there's that international divergence. I mean diversification. I'm sorry. Albemarle it's a big Chinese play with lithium and energy and battery storage. Yeah, it has these tariffs have little to do with that. Um, and Estee Lauder, another around a third of their sales is international. And again, Canada Goose, Estee Lauder, I'm playing that theme that the consumer is going to start spending again. Again, they have pent up savings. They just are hesitant to really spend ever since the housing crisis that they had a few years ago. That just really knocked down their confidence. But again, so I'm pay attention. I'm kind of already explaining what is pretty much my China thesis because this is part of my thesis for 2026 because again it was 2025 on repeat. Okay. Um, we're playing the Chinese consumer spending, what would I call it? Um, revamp, revival, um, comeback, whatever, right? Um, that's basically we're positioning ahead for that. Um, but on top of that, I also have another play, Meituan. Meituan, Chinese um company competing with Alibaba in the food delivery business. Um, they they're having a hard time right now. Alibaba's really sticking up to them. The free cash flow went significantly down this quarter because they're going all in on this battle, right? We'll see how that ends out. Stock price has been down, but I'm still holding. I still think there's a good opportunity here from the technicals at least, and I'm just gonna watch the fundamentals, give it maybe like two more quarters, and if things don't start seeing, if there's no signs of improvement, then maybe I'll have to reconsider um, and cut my position. Another position is Chagi, a drink Chinese based company that sells drinks in China, not only in China but in other countries in Asia. Um, they have a new they have a new location here in LA. I think that's the only location that they have in the US. I want to see how many locations they have because it's not just China. It's here, global stores. Oh no, they have a few in California. My bad. Um, they have three in California, but it's only because I want US. I don't want China US. I want China. Let's go to images. Oh yeah, right there it says on the thing. Anyways, Malaysia, Singapore, Thailand, Chengdu, Yunnan, Shanghai are the three places in China, and then Thailand, Malaysia, Singapore, USA are the other countries. Yeah, they pretty much sell tea. Uh, the stock has been down. I still see fundamentals holding up though, so I'm still holding. It's a very small position. It's um because I know it's risky because this environment is risky. However, um since it's part of the consumer revival play, then it's a little position that we'll just see how it ends up going. But yeah, it's just different types of teas. Not gonna go too deep into that because I don't want to make this episode about one specific company that I'm investing in. I'm just talking about a general theme that I'm expecting for 2026. Again, none of this is financial advice, okay? Um, so yeah, that's what I was buying back then. Um, Now the reason why I am bullish US value and small and mid caps, not large tech, not small tech, not nothing tech, is because, well, look at this, for example. Global defensives as a percentage of global market cap, okay? All-time lows or near all-time lows, I'm sorry. Last time it was at these levels as a percentage of global market cap was in 2000, the start of the burst of the tech bubble, okay? The tech bubble started bursting in 2000. Around the last time this was the global defensive as a percentage of global market cap was this low. Now we're here. Is this a hint that we're about to enter the AI bubble burst in 2026, 2025? Are we? Is it? Maybe? I don't know. Doesn't matter. Point is, global defense is really, really low. Really, really low. Another company I'm investing in on another account, Kraft Heinz, Brown Forman. I'm looking to get into Diageo very soon. Um, yeah, defensive names. Estee Lauder could be a defensive as well. Makeup. One will always buy makeup. Okay. I had another thing for that. Value stocks have been trading at discounts to historical valuations. Okay. Look at the Russell 1000 value down here, S&P 500 up there, and then Russell 1000 growth. Okay. There's a lot more, but I would really have to scroll. Um, I just really want you to know that these small mid cap value stocks are really undervalued compared to these tech companies. Okay. And not only that, but again, as I've said in previous episodes, um, there's going to be a broadening and at least there's an expected broadening in growth expectations for the S&P 500 in 2026. As you can see here, 2025 blend are the gray boxes and the turquoise boxes 2026. As you can see, um, a lot of these are expected to grow. Um, consumer discretionary, consumer staples. I like that. Consumer staples, energy, hmm uh, materials, industrials, and then look, earnings growth, S&P 500, S&P 600. So this is for the upcoming. Let's look at quarter one, quarter four of next year. S&P 600 is expected to have higher earnings growth than the S&P 500 for 3 quarters of the four that are upcoming. Okay. Again, S&P 600 is more diversified portfolio. Let's see. Here, small is oversold on a relative basis, and earnings are set to accelerate. Okay. Sorry, S&P 600. I'm guessing is a small cap weighted version of the ETF. But yeah, okay. Oversold relative to the S&P 500. While earnings are set to accelerate, while there's a broadening in expectation in the market for 2026. Right? Okay. Um, But and here's my thing. December last year, I was bullish China. I was short America. I had no American names. I actually had some, but then I cut them. I was like, you know what? My opinion, I was like, if America has a drawdown as I expected to, which would be a big one, then I feel like every single name would get pushed down with it. So I could just buy the dip after, right? But then I thought, and then I read, and then I learned. Um, well, I've known this for a while, but then I just really thought about it more that um, you can't time the market or whatever the hell it is. Timing the market beats timing the market, you know. Um, and I also read that if you miss like the 1 or 2 or 3 best days of the year, then you miss out on like a certain amount of percentage gains, which is a big amount. Uh, so I was like, you know what? Okay, I whatever. There's a possibility that if there's a drawdown, every name gets slaughtered. But there's also a possibility that it doesn't happen. Or there's a possibility that the drawdown takes longer than I expect, and in the meantime, those names that I was keeping an eye on that I had cut go up, and then by the time the drawdown happens, these come down, but they're higher than when I sold them. Does that make sense? And then we go back up, right? So you could try to time the market, or you could just be in the market, okay? So I decided, you know what? Okay, I'll buy it. I'll buy some of these names that are small mid caps, value stocks. Um, but I'm not gonna go full. I'm not gonna go as heavy as I am in China. They're gonna be smaller because either way, I'm more bullish on China than I am in the US. And if they have that drawdown, and if the drawdown happens soon, as I expect it to be, then these names might come down lower. That's exactly what happened, and then I was able to buy more without as big of a panic as I would have if I had gone heavier originally. Or I could have taken the risk, not have added, waited for the dip, but then again, the dip could have happened way later than I thought it would, and these names could have gone up in the meantime. So by the time that the drawdown comes, when they when they pull down, maybe they bottom higher than when where I could have bought currently. Okay, I hope that's making sense. I hope that's making sense. I just basically I decided it wasn't worth the risk to try to time it if they're long terms and they have their own fundamentals, their own thesis that's unrelated to why I think the bubble was gonna pop. And then we did have a big drawdown in April, 20%. It was pretty fast. Um, I thought it would keep going maybe um like after some consolidation and then pull down again in the summer, but it didn't. Oh well. But yeah, anyways. Um, okay, so but now let's go into why I'm bearish the US market. And then I get asked, how are you bearish the market? How are you shorting the market when you have when you're bullish on these names? Or how can you be bullish on these names if you're so bearish on the market? And that's a good question. Again, I'm bullish on these US names because they have nothing to do with the bubble. If they get sold off with the bubble, I know that the intrinsic value of the company might actually still be going up while the short-term price goes down, just like this graph right here, okay? Short-term stock prices can fluctuate wildly, while intrinsic value can evolve steadily. To illustrate this dynamic, consider this hypothetical chart below. It shows market price, which is volatile, sentiment-driven, and reactive to short-term events, and the intrinsic value, which is smooth, gradual, and grounded in fundamentals. Okay? Intrinsic value, just straight up hypothetical, okay? And then market price, very volatile, okay? Again, short-term voting machine, long-term weighing machine, okay? So here are the 4 points that Tracy Fielder Senior Director, Product Management of US Value Invesco US, said, okay, you have to stay grounded in the fundamentals, know why you bought the company. Again, you're buying the stock, you're acting as a buyer of the company, okay? You're acting as an owner now. Know why you bought it, use volatility as an opportunity, okay? So when if this these short-term fluctuation fluctu but if the market if the price fluctuates in the short term, um, and you know it has nothing to do with the fundamentals of the company, maybe you could use that as opportunity to buy some more, or I don't know, but again, not financial advice. You know what I'm trying to say now, right? Um, understand price formation. Again, really understand what drives the price. What drives the price is um, optimism. Okay, the buyers. If there's no optimism right now, if there's no buyers, then it's gonna come down. But it doesn't matter because at the end of the day, just really pay attention to the intrinsic value of the company. Okay, and avoid chasing the price setters. Okay, the stock market is a price setting mechanism driven by optimism. Okay, so that was a very long explanation as to why how I could be invested in certain companies while being really bearish on the US stock market and even shorting it. Um, yeah, should I go into why I'm shorting it? Because I am. I actually just opened some short positions 2 days ago. I did some 6 month 6 month out put swings on the Nasdaq. I'm swinging a micro ES short position. I am starting to build a VIX call swing for May, and I'm leaving room for all of these to scale in if I need to, because this might take a few weeks to set up or play out, whatever. And here's the reason why. Oh, before we go into the short-term technicals, let's go into. Oh God, I want to keep this as short as possible as I can. First of all, I'm gonna have to talk about silver, gold, and okay, let's just talk about commodities. As you may or may not know, commodities like silver and gold and platinum and copper have been skyrocketing this year, and mainly silver and gold are because other than AI and the infrastructure and all that, for like platinum and copper, for gold and silver, um, a lot, at least suspect it to be, is because of the long-term debt that the US government owes, or short, like not even long and short term, just the total debt that the US government owns. Um, it's in the trillions, it's very high. And um, I'll have to, it's not letting me search. Fuck. Sorry, give me a second. Here we go. Okay, so here are the phases, okay? And I learned these from Ray Dalio, okay? First phase, US bonds pump, dollar weakens, okay? Dollar won't follow the US bonds upwards because it's due to inflation and policy failures, creating a loss of confidence in Fed, which can weaken trust in the dollar. Second phase, US bonds dump, dollar weakens. Less lending to the US will cause panic selling of the dollar, further weakening it, and bonds as well as money moves to foreign currencies, bonds, and markets. And third phase, political extremism increased wealth gap, and civil war slash revolution. Okay, again, silver, gold, U.S. debt, whatever. Point is, there's a loss of confidence in the U.S. government's ability to pay off its debt. So people sell off the dollar and they start to buy gold and silver as a hedge to that. Okay. Um, US bonds haven't really pumped much this year, but they've held up this year, contrary to 12 months ago where everybody was super bearish on bonds uh, going into this year. And just really pay attention to the dollar, okay? There's a loss of confidence in the Fed. Um, although the stock market may not show it, the dollar and commodities are showing it. I think they're showing that they're really not liking the risk of Fed independence, as Trump has reiterated that he is going to pick whoever listens to what he says. Okay, um, which again will end up being inflationary if they just recklessly cut rates. Second phase, U.S. bonds dump, dollar weakens. Um, I'm just not very sure if we're in the first phase or in the second phase. I think we're in the first phase, but maybe not. I that's just because I don't have a clear. I'm not certain where the bonds will go from here. But point is, doesn't matter because in both phases the dollar weakens. Okay, that's what the main focus is, which again is another part of the thesis of playing China or international stocks. When the dollar weakens, international equities outperform. Okay, got it. Good. Dollar weekend this year. What happened? International equities outperformed. Um. So yeah. Uh. Anyway, so I was going back to that. Why was I talking about gold? Oh yeah. Okay. So yeah. Well, first of all, that government can't pay off all that debt. Okay. And this is why Trump wants to cut these rates so that they could pay off debt at lower rates, at lower interest rates, or reconsolidate debt at lower interest rates. Um. And I think gold and silver is has caught up to this. They're not cutting rates for the right reasons. Okay, they're not cutting rates because the economy is saying is what's needed. They're cutting rates for the government's own interest of needing to reconsolidate that debt at lower rates. Okay, that's a big picture. Apart from the bubble, so obvious already. Um, the tech bubble, everything's just over. This chart is just so extended. Look, I'm a technical guy. Okay, I play what the chart tells me. If you just look at the chart, if you just look at the chart, like, do you like make this make sense? Make this make sense. Like what? You don't think there's a mirror version set to come soon? I do. I don't know about you, but I do. That's my opinion. Anyways, um, oh shit, sorry. What did I do? Okay. Yeah, the front VIX future keeps lagging its S&P beta. The 8-day moving average is amongst the worst year to date, and Friday marked a 9-session underperformance streak, tied for the longest on record. Look at the last two times it lagged this much. It was back, well, like December 2021, and this would be like March or April of 2024, and then I highlighted it here. What happened here? December 2021 is when it gives a signal, and then we have January going into March, just a dump that year. Okay, and then we have it next again, March, April. We have that dump also. Okay, okay, March, April, May. I don't know. Okay, so just look at that, and now we're over here. So now the question is, do we go down? So since I charted this, we've gone up. We made a new all-time high, but still, again, these things are big picture. So I really don't care about short-term price action, which is why my swings that I've started to build are months out. Maybe I should even go more than half a year out. Okay, so just take that into consideration. The VIX measures the S&P 500's volatility, sorry, expected 30-day volatility, while the VVIX measures the expected volatility of the VIX itself, essentially gauging the volatility of volatility or market uncertainty about future market swings. Think of VIX as predicting big market moves and VVIX as predicting how much the VIX will change. This drop implies that traders are not paying up for downside protection via SPX puts or VIX calls, even as the tape has looked heavy and traded sideways this week. This was last week, but still, okay? This implies that traders are not paying up for downside protection via SPX puts or VIX calls. So what am I doing? I'm doing the opposite, okay? So when they get slaughtered, you're not one of them, okay? Or I'm not one of them. You talk to your financial advisor and figure out what you're gonna do. All right. Apart from that, what are we doing? We're going, it's in perfect tandem with the volatile seasonal period coming up for the volatility S&P 500 index, okay? You see this? Go into January, mid-January, and then with this very volatile period into March, okay? Dealers remain long gamma, getting longer on rallies and shorter on sell-offs. The setup doesn't flip short until roughly 2.5% lower according to GS estimates. Um, I tried a silver feature short on Friday after setup. I got screwed. Oh, look at this. Did I talk about this in my last episode? Where did we leave off on my last episode? Was it here? Sheesh, I'm not sure. Wait, because I don't want to go over things that are. Hold on. Give me 1 second, okay? Let me check this. Anyways, I hope you guys have a good Christmas. I hope you're able to spend with family, with loved ones, friends, people you really care for, people that really care for you. Um, just be safe out there. Be careful of drunk drivers. Don't drive while drunk, please. Um, okay. 6 days ago, the 18th. Okay, so I guess I have it. Or maybe I have. I don't know, whatever. Let's just whatever. FOMC members see upside risk to the unemployment rate forecast. Net percentage. Yeah, so much longs. Short interest. Yeah, we talked about this. We talked about this. I don't think we talked about this. Inflation cooled off, but this people are very skeptical about this last inflation report. Um, given how they like, there's a lot of error in this report, so I would not take much away from this. A key thing that there's an issue with in the sense that when they're sampling the data, specifically around November, that the survey period was condensed into later in the month when you typically have significant holiday shopping, holiday discounting, I mean. And when we spoke with BLS, they said they're not doing anything to adjust those seasonals. So that automatically makes the data artificially weak. Immigration slowing dramatically. Silver, the RSI monthly, I think that's the daily, but this is like we're higher now, so RSI might be higher now weekly. Um, extremes, man, extremes. Okay. Silver volatility back at extremes, not sustainable. Any pause or downtick likely to trigger volatility reset as traders monetize upside calls, risking renewed pressure on spot. 3 months call skew 100%. Okay. Panic upside, max. Okay, so it's somehow still going up though. I don't get it. I tried to short on that. Who I was like Friday. I got squeezed. I got squeezed. I tried playing this. There was an inside bar or bearish Harami, and instead of getting downside on this candle, which was Friday, I think we got upside, broke above this, so I stopped out. Um, See, this was the setup. Okay, this was how it looked, but it just didn't work. It just I got squeezed. But the setup was there, so I was like, it's worth the risk. It's already very overextended. Um, so let's just try again next time. Um, but yeah, so I'm bearish. So I'm pretty much just hedging myself. I'm not going full tilt on the US short positions. They're acting as hedges. I'm just very I'm very cautious up here right now, as I was a year ago. A year ago around this time I had hedges again, but it took 2 months. No, between now and February was very choppy, downside but very choppy, and then up. It was very range bound. So there was a lot of volatility. Um, but yeah, I'm just being very cautious. I'm probably gonna focus on China longs in the foreseeable future. Don't know, but again, like everything, all those charts that I showed about the volatility and all these like overextended levels and things like that, I think we're due for a mean reversion very soon. Okay. And there's more stuff. Let me just go over this now since I'm here. Companies are increasing rolling out dynamic pricing based on AI to generating prices and offers hi- that hinge partly on what the AI thinks you're worth as a customer would pay. It's difficult for consumers to truly understand how this works, other than it's probably leading them to pay more. Consumers are in the dark about AI's machinations. Companies are loath to discuss details of their pricing algorithms. Partly that's for competitive reasons. The consumer and regulatory backlash is also brewing over AI being used for unfair trade practices and illegal forms of price discrimination. If AI helped everyone get better deals while pumping up corporate profits, there wouldn't be much concern. But academic studies indicate that AI-powered algorithms working competitively wound up raising prices for everyone. In 2019, academic researchers in Europe concluded that AI algorithms consistently learn to charge super competitive prices, resulting in tacit collusion. More recent research has found similar findings. A recent study by Carnegie Mellon University business professor Param Singh and other researchers concluded that personalized rankings using AI algorithms increase prices overall for consumers by an average of 29% or 13 if they're accounting for the economic benefits of more convenience. When algorithms personalize how products are ranked for each user, they tend to learn to charge higher prices overall. Okay, so we already got, damn, add this with the inflation that's bound to happen if we get unnecessary rate cuts. Not looking good, huh? America's electricity bottleneck in charts. China has more capacity. Okay. Um, but this is annual electricity generation. So China generates more energy, but they also have more capacity to generate more energy. Um, Transmission congestion shortfall. The everything rally from international to US technology. So I was right about for 2025. I was right about my China thesis. I was At the end of the day, I was wrong about my US bearish thesis. We did get that April dump, 20% drawdown. However, we ended the year positive, and I think I was expecting a red year on the US indices. So I was wrong. Okay. But it's just very funny to me how a full year later, and we're like back in the exact same spot. Tech overvalued, small mid cap value undervalued. Um, Charts and technicals and fundamentals are pointing, and outflows and inflows and sentiment is all pointing for these again small mid cap and value stocks to outperform in the near term future, hopefully, and because everybody's bearish on this, Everybody's bullish on this, and everybody's already positioned in this, and nobody's positioned in this. So when the tides turn, it's gonna be, uh-huh, crazy, right? Golden Saber had tended to move inversely with the US dollar. You see, example of China's lead over the rest of the world. Bigger share of industrial robot installation, bigger share of global commercial shipbuilding, higher high-speed rail links, bigger share of top-tier AI researchers, bigger share of EV production, bigger share of new nuclear reactors under construction, bigger share of global manufacturing value add. Oh my God, China. China's the leader. Power generation, China has twice the solar and wind capacity under construction as the rest of the world combined. Batteries, two firms alone control nearly half of global EV battery production. Strategic minerals, China refines 99% of the world's gallium, 95% of the world's graphite, and 92% of the world's rare earths, to name a few. Drones, a simple company, accounts for more than 90% of the global consumer drone market. Shipbuilding, China's leading state-owned shipbuilder built more commercial vessels in 2024 alone than the entire U.S. shipbuilding industry has built since World War II. High-speed rail, China boasts a high-speed rail network longer than all the countries' networks combined. You get the picture. Of course, this propensity and capacity to build has rested on physical infrastructure that is second to none. In China, most of the electric grid has been built or modernized in the last 2 decades. Ultra high voltage transmission lines carry electricity over long distances, enabling modern transport systems. The country now generates more electricity each year than the US and European Union combined. As a result, and owing to its overflowing renewable capacity, China's electricity prices have gone up, not up, have gone down, not up. Okay, electricity prices for China have gone down, not up, something the US and Europe each lack. It's also much cheaper to build in China. The average cost to construct a high-speed line, for example, comes in at around 33 million per mile, or some 40% cheaper than in Europe and 80% cheaper than California's long-delayed high-speed rail project. It doesn't hurt that the country has some 70 million industrial workers at its disposal, or that science, technology, da da da, are what students are majoring in, whatever. Um, China increasingly counts on emerging economies to absorb exports. Okay, year-to-date evidence of trade rerouting from China more to Africa and Asia and Latin America. So while this high technology accent has been impressive and will surely define U.S.-China relations for years to come, its pursuit of exports overall has come with its fair share of drawbacks. Subsidies have fueled market inefficiencies and relentless competition, hardly the recipe for margin expansion and healthy profits. Hence, the government's latest anti-involution campaign that hopes to correct overcapacity on the supply side. And yet, true reform on the demand side is still missing. Weak consumer demand only raises the stakes on exports to continue driving economic growth, fueling concerns of prolonged deflation. Not completely tied to this, but bringing up Meituan again. Government's latest anti-involution campaign that hopes to correct overcapacity. They're also starting. They've also started creating the stance against competition in pretty much anything that's where it's just obnoxious. Um, they've already told food delivery um, companies to dial it down on their food war delivery battle, and um, I think China's now actually working on fixing this part of their of their policy that leads to over competition and um, wrecked profit margins for these companies in any sector in China. And if they really stand their ground on this stance, that they want to stop these companies from doing that, then it could be good for the end of the food delivery war. I don't know though. I really don't know. Uh, Companies that sell internationally. Stocks with higher domestic sales have been underperforming amid weaker dollar. Okay, which means what? Stocks with higher international sales have probably been overperforming with the weaker dollar, and this could be very good for Estee Lauder. Um, Weaker dollar, if I'm understanding correctly, it would make their products cheaper to international consumers. Okay, Bank of America's contrarian sell signal just got triggered, 8.5. Um, 1 or 2 weeks ago, it was at 7.8, 8.5, 7.8, big jump. Bank of America bull and bear indicator since 2002 at highs. Okay, again. U.S. margin debt 12-month increase large relative to XPX gain. About the margin debt, right here. U.S. margin debt is rising faster than the market, a pattern historically seen near prior market tops and often a precursor to higher downside risk. JPM positioning team. Margin debt is highly correlated with SPX levels, so elevated readings alone aren't necessarily bearish, but concern rises when margin debt grows faster than the market itself. A pattern re-emerging recently and one that has preceded past drawdowns. At 2007 peaks, margin debt increased much faster than market rallied. Okay, here, what happened here? Don't know exactly what happened here. I know 87 had a crash, but unrelated it seems. Um, so yeah, what was this? 2021. Then we had a bear market for that year, 2022. Um, just not the levels yet as these last times, but it's something to keep an eye on. Okay, difference in Solomon changes for margin debt versus SPX were high in 2007 and similarly high in 2021 and 2025 on a 10-year Z-score basis. Okay, okay, keep an eye on the margin debt. Back to where we were. Buy insurance when it's cheap and when you can, not after the damage when there's no point. Okay, okay, went over this already. We went over this already. Went over this already. So yeah, I tried the silver futures short on Friday, got squeezed. Still worth keeping an eye on though. Um, economic stuff, lower middle income, of course, higher income people having it better. Uh, you could pause and read it, but yeah, same old story. 6 trillion to passive versus 3 trillion from active equities. Okay, people in the past 10 years, more into passive, less into active. Stock pickers market. Okay, this is why I'm not investing in ETFs or whatever. I'm investing in specific companies that are unrelated to the tech bubble, small mid cap, and value stocks. Okay, and defensives. Investors positioning for profit acceleration in 2026. Okay, net percentage of fund managers survey investors that are positioned for profit acceleration in 2026. What happens if these people don't get acceleration, bro? They'll get bagged. Bag city. Inflows to equity ETFs, of course, on course for record 1.4 trillion per year. Active equity fund on course for record year of outflows again. Stock pickers market. It's coming soon. It's coming soon. I thought it was gonna happen this year, but it didn't. Tech still leading the way. But this month we started seeing since yeah this last 30 days we started seeing signs of broadening. Hopefully, okay. Another thing that I wanted to add, apart from timing the market and just being in the market and buying those stocks, despite being bearish on the market. Another thing is I learned that during Japan's stock bubble collapse, what year was it? I don't know, 2 decades ago or something like that. When they had their bubble pop, it popped, but there were certain winners in the market. There were certain winners, and let me find it if I can. Okay. Uh, Let me see if I can find it. Okay. Tariffs will ultimately benefit small caps because it forces money to domestic economy from international exports, although it's inflationary. Not this. Large caps have the benefit of passive flows, but if there's underperformance of passive versus active, then see slow money trades first need these small mid to actually start performing. Here we go. During Japan's long deflationary slump, a lot of good stock pickers made a lot of money in Japan. They were excellent Japanese companies, and if you knew how to pick them and didn't buy the wide indices, you could do quite well there in the 80s, in the 90s, and early 2000s, right up into today. You just couldn't buy the whole index. And what was the index doing in the 90s and early 2000s? It was not doing well. Okay, so this just goes to show that there's always a chance that maybe certain companies do fine while the market shits itself. Okay. Anyways, the revamped bull and bear indicator says investors greedy into 2026. New one, the old one would have been down here. New one up here. Okay. And greedy. Be fearful when others are greedy. What did I say? I said that somewhere else here. Um, yeah, here, right here. Okay. Look. Wall Street's 2026 stock forecasts are anonymously bullish and clustered. Okay. Smallest gap since 2017. Okay. So the smaller the gap, that means estimates are closer towards one side, and the bigger the gap, there's a bigger variation of estimates on both ends. Okay, so yeah, more people agree on target, narrow gap, less agreements on targets, wider gap. There's more people agreeing on bullish targets, and how do we know it's bullish targets? Because we have the targets here, and everybody has a higher target. Well, Fundstrat, Deutsche Bank, CFRA, Morgan Stanley, Citi, Goldman Sachs, Barclays, JP Morgan, Wells Fargo, Oppenheimer, RBC, Bank of America, UBS, and Evercore. Higher targets. Okay? So be fearful when others are greedy. Okay? Especially when cash levels are at lows, 3.3%. It's crazy, outrageous. Um, yeah, man. Percentile rank of FMS growth expectations plus cash plus equity. Yeah, man. Just hedge funds are stretched. Global hedge fund leverage, both gross and nets, is above 90th percentile any time period you measure. Stretched, man. Be careful, man. Goldman's U.S. equity sentiment indicator measures stock price positioning across retail and institutional and foreign investors for the past 12 months. Jumped to its highest level of the year. It has not been in stretch territory since December of 2024. Exactly a year ago, as I was saying. Fast forward a year later, we're in the exact same spot. Stocks eye largest monthly winning streak since 2018. That's it. This month closes green. Crazy. Thought we'd close red this month, but it is what it is. Silver gold ratio at 5-year highs. Something on student loans. Termination to start seizing pay of defaulted student loan borrowers in January. Start garnishing wages of approximately 1,000 defaulted student loan borrowers early next year. They could withhold up to 50% of an employee's income for their debt, with default occurring after 270 days. As of June, 5.3 million borrowers defaulted on 117 billion in student loans, with 4.3 million more nearing default. Right? This is the same thing, huh? But yeah, only 1,000. But again, notices to others in default will increase in scale monthly after that. I hear how to know when households stop paying their student loans, their credit scores will go down. Households with a FICO score higher than 760, the average credit score change associated with the new student loan delinquency is a decline of 171 points. 45 million people have a student loan, and about 11 million people, or 25, are either in default. I think this is going to have an effect on the consumer, a big effect on the consumer. And just look. Soft data is collapsing. Hard data holding up. Last time soft data led hard. Wait for these. Wait for these. Wait for the Department of Education to start collecting their money, start garnishing wages, start getting their debt back, collecting that debt that these former students own. Just wait. I think that's gonna have an effect on the consumer, on consumer spending and everything, and we then might see hard data catch down to soft data. We have to wait and see though. It's just a prediction. It's speculation. Oh my gosh, some good stuff, huh? 55 minutes and counting. We're almost done. We're almost done. I really gotta finish this up. I gotta go run after this, and then Christmas Eve I have to change and trim Dino's eyes and just around his eyes because his hair is getting long, so you can see better. Okay, this is from the Stock Traders Almanac of 2025. Um, Here, when the Dow closes below its December closing low in the first quarter, it is frequently an excellent warning sign. He noted that the trend. Okay, so Hooper dismissed the importance of January and January's first week as reliable indicators. He noted the trend could be random or even manipulated during a holiday shortened week. Instead, said Hooper, pay much more attention to the December low. If that low is violated during the first quarter of the new year, watch out. Hooper's watch out warning was absolutely correct, though. All but two of the instances of 1952 experienced further declines as the Dow fell an additional 10.9% on average when December's low was breached in quarter one. And that is exactly what happened this year. That is exactly what happened this year. What happened to the Dow in the first, so whatever had the December low, and in the first quarter, it broke below that low. Let me just show you. Let me just show you. December. What was December low? This December? Not this December. 415. Okay, breaks below this. Literally, like 2 weeks later, in the first quarter, it breaks below 412. Okay, and then we go into the second quarter. What happened after? It proceeded to drop another, let's see, that was at least 10%. It proceeded to drop at least another 10%. Okay. Uh, that is exactly happened. That is exactly what happened. Okay. The Dow broke below its December low in the first quarter this year. And then what happened? It experienced further declines as the Dow fell an additional 10.9% on average when December's low was breached in quarter one. That happened, which was another reason why I was bearish this fall after summer. Um, but we never came back down. I thought we would just close the year red, but no, we closed the year green. Um, but yeah, because on all these instances, when that happened, there was another big low, except for like 2 or 3 cases. Other three significant drops occurred when December's low was not reached. No, but yeah, here I highlighted the cases where it happened. But from when it crossed, okay, so 1952 is kind of similar to this year. So we had the December low, cross before the December low, below the December low, right? That's a subsequent low was 256, which was almost 2% lower. But then the rest of the year it went positive and it closed positive. This year we had the December low, we broke it in January below, but then we had a subsequent low, but months later of more than 10%. But then the rest of the year it went positive. But typically when that happens, the year ends red. Look at these. Typically it ends red. The only times where that didn't happen was 1952 and 1970. And now, oh, and 1982. And now you can add 2025 to that. But usually it ends red. Um, so I want you to keep an eye on that. I'm gonna keep an eye on that. Again, I'm gonna watch the December low and to see if the price breaks below that again in the first quarter, okay? And then that might give you a signal of how the year is gonna go. And apart from that, combine that with the Dow Jones Index 4-year election cycle. It's very, very choppy. This is different than the S&P 500s, okay? This is Dow Jones 4-year midterm, okay? We're going to midterm year. It's very, very choppy, okay? It's very, very choppy. It's not really good. Look, here's a better view, okay? Usually have a weak um middle period, June to September. But yeah, if we break December low in this first quarter, then watch. Yeah, it's not looking good, right? But then the S&P 500 midterm year is drastically different. Look, midterm year is very bullish. Matter of fact, approximately 80% of midterm years have ended with positive full year returns, with an average annual performance exceeding 19%. So look, I gave you two different scenarios, or I gave you two different charts for two different indexes. Okay, so keep an eye on both. Okay, just keep an eye on both. They're two completely different. Um, the anonymity and the clustering of outlooks is concerning to me. If everyone is expecting the same thing, then by definition, it's already priced into the market, especially when the rationales for the consensus outlooks are so often pre- predi- predicated upon similar foundations like rate cuts, tax cuts, and continuing dominance of AI. From Steve Sosnick, Chief Strategist Interactive Brokers. The not insignificant amount of good news already priced in includes accommodative Federal Reserve that will cut rates at least once, if not twice. SPX earnings to grow by about 40%, fiscal bump from the recently passed state law. It seems like folly to think that these would not benefit stocks. Those expectations have been a boon to markets, and it's logical that they would continue to be. But as noted above, if they were already well expected and they're already priced in, one must consider whether simply meeting these expectations will be sufficient. If not, then we could see disappointment even amidst a good investment climate. And if they are not met, then the disappointment could morph into something much worse. Okay? That's crazy. That's crazy, right? Wow. That's it for this episode. We went an hour. That's crazy. Look, I could go even deeper and deeper and deeper into the Chinese thesis, but I gave you the general broad picture. Okay. Um, I feel like I covered everything. And yeah, just do your own research, talk to your own financial advisor. None of this is financial advice. All of this is opinion only. Um, so what I would like to say is you just really have to try to take in as much information as you can from various sources. And after you do all that, you filter everything and then you base your own opinions off of everything you learn. Create your own opinions and everything, okay? Take it all in, you filter it, and then you do your own thing. Okay? Thank you for watching.